Now, Swami, another term often used, tax revenues and non-tax revenues. And again, within tax revenues, we constantly hear of direct taxes, non-direct taxes. What's the difference between all of this?
Direct taxes are taxes paid directly on the basis of your income. So if I'm paying income tax, that's a direct tax. Corporations pay corporation tax. So both these are as a percentage of their income, so they are called direct taxes. Indirect taxes are levied on goods, not on individuals' income. So if I levy an import duty on goods and services, that is an indirect tax. If I put a sales tax, if I put an excise duty on certain kinds of goods, all those are indirect taxes. There used to be a time when the indirect taxes accounted for most of the revenue. It's now the other way around. The direct taxes account for more and the corporate taxes most of all. Then there is what they call non-tax revenue. For instance, there's a certain amount of interest that the central government is getting on old loans that it gave to the state governments. That would be non-tax revenue. It's income, but it's not tax. Again, the government may say, I'm going to sell some of my shares in some companies. Or as happened last year, the government may say, I'm going to sell some of my spectrum. Or the government might sell some of its land. All this would give you income. It would not be tax. This would be non-tax revenue.
All right. Now, we spoke about the fact that, the government goes to market and borrows. What are market borrowings all about? How is it conducted by the government?
There are many countries where the financial markets are big, wide and deep. And in those countries, the government or any corporation can say, look, I'm going to float bonds of so much. Now, when the government says, I'm going to float a bond of 10,000 crores, it's another way of saying, I want to borrow 10,000 crores. I give you this piece of paper, and on the basis of the pieces of paper, I pay you a certain amount of interest, and at a certain period of time, I repay the loan. In India, it used to be done almost entirely within the banks. We didn't have a large market of individuals and corporations subscribing. So the market borrowings in India at one point of time tended to be almost entirely just borrowings from the banks. And since the banks themselves are almost entirely owned by the government, it was almost like transferring money just from one wing of the government to the other. But now it's got broader. There are a number of private sector banks. There is what they call a debt market. Increasingly, there are individuals, institutions, even foreign institutions, who want to put a part of their money into buying these government bonds. So the government will judge its expenditure through the year. The government will then say, in June I need to raise 10,000, in October I need to raise 30,000. And you will plan that during the year, I will announce there is this large issue of new government bonds, and between the banks and the other institutions, this will be sold. It can be done at an auction at the best possible price, but over and above that, the banks are obliged to hold 25% of all their money in the form of government bonds. So some of that is compulsory borrowing.
Now, we did talk about fiscal deficit, and you did break that down for us and tell us what it means in the simplest of terms. Another term that is constantly used and heard of is current account deficit. How would you define current account deficit?
The current account deficit refers to the balance of payments. In the balance of payments, we have imports and exports of goods and of services. If we are importing more than we export, there will be a trade deficit. On the services, services and interest, things which are not visible in the form like goods are. Like for instance, export of software, it's not visible. You don't go through a customs officer. Remittances that come from abroad into India, they're not visible. They just land up in the bank. So we have the trade in merchandise and we have the invisibles. So if there is a deficit on account of the trade and a deficit on account of the invisibles, because in the case of invisibles, we may be having certain payments we make abroad and certain payments that come in. If there's a deficit there or surplus there, we adjust that against the trade deficit. So you take the trade deficit, or should we say the trade balance, it may be plus or minus, plus the invisibles balance, add them together, That, if it's a deficit, is a current account deficit. If it's a surplus, it will be a current account surplus.
All right, now again, when you talk about current account deficit, and we've stayed a current account deficit country for long, you keep hearing of people say that, if the current account deficit widens, the currency is going to come under pressure. Why is that?
Because it's a simple question of supply and demand. Whenever you are exporting, dollars are coming in. When you are importing, dollars are going out. If the deficit becomes larger, it means more dollars are going out than coming in, so there's a shortage of dollars. If there's a shortage of dollars, then it will tend to affect your exchange rate, it will become weaker. If the current account deficit becomes very large, then the impact can be even larger. However, as against this, there's something called the capital account and the capital inflow. So even if I have a current account deficit of 3 billion, but foreigners are willing to invest 10 billion, on balance there is an inflow. So the current account deficit can be taken care of if enough comes in on the capital account.
All right, Swami, thanks very much for coming in on the show and joining us on Budget 101 to make understanding the budget a lot more simpler for our viewers. That's it on Budget 101. Hope this year's budget becomes a far easier one for you to understand. Thanks very much for watching.